I generally look at all the forward-looking indicators that I've been using for the last 20 years. Most of them are weakening, showing weakening growth. I don't have many things that give me a recession yet. So it kind of feels like 2006, where the yield curve remained inverted for a period of time before the actual bad news comes. My head remains with my core framework, which has been we are still in a disinflationary world, and that interest rate rises are self-limiting because everybody's too indebted and the aging population, and that trend in bond yields I call the chart of truth, where bond yields go down over time, holds. That is currently the least popular view from most people. Everybody, and I've interviewed everybody that I know and really respect. You know, just did an interview with James Aitken, Gerard Minack, Kirill Sokolov. They've all changed their macro view. They're like, structurally, we think there's long-term inflation. And their view is, we think there's long-term inflation because of the amount of spending that will happen to transition to ESG, and there's not enough commodities to deal with that. Absolutely true. That supply chains are coming back to regionalized, so people need to build new factories. And I think that's true too. I still think that the demographic story is larger and that demand for commodities is driven by the economy itself. And so I know it's fiscal stimulus, but at the margin, if households spend less, then the price of commodities comes lower. I think overall, I still think commodities come lower than here. The big question for me, I think we're headed towards recession. Now, again, as ever, everyone's saying, well, this time it's different. The forward part of the twos curve doesn't suggest interest rate cuts. The 3-month, 10-year is not inverted. You know, there's always a but this time. I generally look at all the forward-looking indicators that I've been using for the last 20 years. Most of them are weakening, showing weakening growth. I don't have many things that give me a recession yet. So it kind of feels like 2006, where the yield curve remained inverted for a period of time before the actual bad news comes.
And it's interesting because today you saw a robust jobs number, right? Well, over 400,000, you've got the unemployment rate. You do have things that are indicating that the economy looks strong, but they are a bit rear view mirror, right? So what are you seeing, right? What are you seeing that, or what leads you to believe that we are going to go into, or at least growth is going to weaken substantially if it's not an outright recession? Is it just the natural course of the economy? Has it been happening already, or is it because of the Federal Reserve?
No, it's happened because of commodity prices. What we've had is a massive tightening of monetary conditions because wages have gone up 5% and inflation's gone up 7.5%. So what you've done is destroyed demand by 2.5%. So that basically, if the trend rate of growth is 2.5%, you've just gone to zero. So I see that in inventories to new orders in ISM. That relationship suggests that the economy is headed to pretty close to recession. I look at shipping, freight, all of these indicators, the year-on-year rate of change, they've all gone to recessionary levels. So something's going on. Consumer sentiment, the University of Michigan's consumer sentiment indicator is recession levels. It's consistent with the yield curve. Small business optimism, falling, not yet at recession levels. ISM new orders, falling, not yet at recession levels. The ECRI year-on-year survey, the Economic Research Cycles Institute, that is, again, pretty low, near zero. So there's a lot of indicators that are like, listen, ISM is likely to get down to between 52 and 50 between June and July, something like that. Usually the Fed stops when that happens. I don't think so, because I think demand has been destroyed already. And, you know, mortgage rates have gone up a lot. We're seeing housing market cooling down. So all the things you'd expect to see are happening. So, you know, I think the moment, oil's has been coming off, and it's still kind of a bit sideways-ish, but if it breaks much lower than, let's say, 95, it could go back down to 80, and that takes a lot of pressure off. Wheat as well. I did the work on the stocks to use ratio of wheat, excluding China's massive stock of wheat. It's still pretty high. It's as high as it's been in the last 20 years. So as long as we don't have a terrible harvest in wheat, we're not going to run out of food. So I think that the market might have over-extrapolated the trend. And I think that if the ISM comes down to somewhere close to 50 by the summer, the Fed might have done another 50 basis points or 75 basis points, but they're going to say, well, let's just watch and wait and see. Now, we saw this playbook in 2016. The Fed were like, yeah, we're going to raise rates 4 times this year. They raised once and then didn't do anything for over a year. So let's wait and see. I think because the yield curve is later in the cycle, unlike 2016, I don't think they come back again and start raising. If they stop, they stop.